Good morning, everybody. We already have 45 people on the call. I think we don't want to keep you waiting. We are extremely pleased that so many of you actually are joining us for this call. We have a lot of topics to discuss, and that's why we immediately jump to the first section and I pass on to Marcos.
Yes, hello. Good morning. Thanks all for joining the call this morning. We move to page 2. You can see there that we have a busy schedule today. I'm going to start with the base case scenario from a macro perspective, and then I'll touch a little bit on value. Alex will go deeper on value and index or passive management, then the two funds, and finally we will have Carlos on the future of energy. I will speak on Salmon, and Urs will get through his natural resources thoughts.
I will start first with the base case scenario from a macro perspective on page 3.
I will start first with the base case perspective, page 3. And we are a little bit different from the rest here because for us, the base case scenario is that we are ending the economic slowdown will still be kind of a tough first half, and then we will see a recovery in the second half of the year.
Factors
behind this growth were lower interest rates, fiscal support, and capex, so investment or FAI. The main uncertainty now is Trump, obviously, and his policies, and this brings a lot of uncertainty. But we think, in our opinion, which is not really very insightful, we should be doing well even with this uncertainty. So you can see in the chart here in the table our estimates for GDP growth. Europe clearly moving up in 25 and 26. The US better, above 2.5%, and China improving a little bit. So, summing up, we think we are going to reaccelerate in 2025. And this should be positive for value for commodities. Moving to page 4, you know that we follow very closely the industrial production index, and you can see here that we had 3 years of a slowdown in industrial production globally, which ended up in a big destocking last year over, and the industrial production should start a new cycle more or less in the second half of this year. These up cycles from an industrial perspective, they take 2 years normally. So we should have positive momentum 2026 and 2027. Same issues here with Trump's policies and the uncertainty that this is adding, but we think that the base case is this one. Also, it's important to highlight that maybe we are not a macro specialized team, but we get a lot of information from all the companies we follow. So we probably spoke to more than 100 companies in the past 2 to 3 months because of the results release. And we get a lot of insight on what is going on in every country, in every geography, every sector. On inflation, in page 5, you can see that we moved to a more bearish view as from last year. So it's amazing that inflation is back to normal following the huge spike following the COVID. Now inflation in developed markets is 2.5–3%. In Europe, it's even below. And developed market in emerging markets is already around 2%. And now we see upside pressure here, where wages, investments, monetary and fiscal policies, reshoring, tariffs, the Trump policy, commodities, energy, electrification, so the transition, and even technology, and even defense. So here we see that the utilization of capacity worldwide is important, or is a high level, and we see inflation pressure. Nothing to do with what happened after the COVID. The next slide, final comment on China from the macro perspective. We see a stabilization. And we choose to put that chart here where you see what happened in terms of fixed asset investment last year, so investments, 2024. You see that across all the sectors, there was substantial investment last year, even double digit in some of them, like electricity, gas, and water. But the 2 sectors that heavily underperform are property and construction, which obviously are interlinked. So, again, the same picture in 2024. We think that the Chinese property cycle is coming to an end. It has been going down. This is the fourth year, and normally the downturns take 2 to 3 years. So we think that China will also improve this year. Conclusion in page 7, a little bit contrarian because everybody's a bit afraid of Trump's policies and the impact in the economies. We expect a global acceleration, not massive because we didn't have a recession, which means that the starting point is quite high. And you see the risks, inflation, deficits and debt, tariff, so policies from the Trump administration and geopolitics. Again, on a positive side, let's see, but we could see the end of the wars in Gaza and Ukraine as positives. So no change for us. We are a bit more optimistic regarding 25 and the next couple of years. Moving to the next part, I'm moving to the value. I wanted to just spend a couple of minutes on value and the value cycle in page 9. You can see we draw this World War, and you see that we have seen 3 value cycles that are 10 to 15 years long, and 3 down cycles means growth beating value, also 10, 15 years. And we think we are at the end of the 3rd growth cycle, and the 4th value cycle has probably started in 2020. Why we think so? Very basically, valuation. It's the big discrepancy here because growth is showing at 26 times. Historically, it's like 24. And value is showing at 14 times when historical average is around 17. So there's a big discrepancy or large discrepancy in valuation. Then there is obviously the maturity of the Magnificent Seven, which are a heavyweight in all indices and a heavyweight in passive and a heavyweight in growth. And then there's the economy. If we are right in the economy and the acceleration of the cycle, inflation, capex, commodities, this is very linked to value. So just on a basic or fundamental approach, and you see that in the headline down, value outperforms 80% of the periods using 10-year rolling periods since the Second World War. I mean, this is basic. If you have a value strategy, you're buying at a discount, and buying at a discount will always add some alpha. Next slide, in slide 10, you can see a chart which is impressive. I wouldn't believe it if I don't see it. If you take the light blue line, which is global value funds as a percentage of the large cap funds, in 2006, they were 30%, almost 1/3 were value, and now they are 5%. So really here, you see that value is completely out of interest and even out of business, and passive has gained massive market share. Why? Very strong performance of all indices, basically the US and the Magnificent Seven having a huge impact there, and also concentration of the asset managers. So you see that the asset managers now, the large ones and the private equities, they're no longer managing tens of billions, they're managing hundreds of billions. And it's very difficult to be very active with this scale. They're competing on basically on technology and on fees. And then you have a huge impact also that we see this every day here in SIA is the algorithmic and the quant impact, which is, it's amazing the impact they have. In our view, the outperformance of the Magnificent Seven cannot be sustained. Valuations are too high. Then you have new entrants, technology risk, AI regulation, and the market share is already very large. So, okay, they are good businesses overall, but it's going to be very difficult that they repeat the performance of the last 10, 15 years. And finally, in this aspect, on the 4th value cycle, I wanted to do a reality check. So I said, okay, Marcos, you think that the value cycle has started? Let's check it out. I went to 2000 and I did the chart with Standard & Poor's 500 equal weighted, so excluding the weight of the big guys. Then I put growth, I put value, and I put our classic. And if you analyze the last 5 years, you can see that growth and the Standard & Poor's X Magnificent Seven or equal weighted is up 21% per year. Obviously, we're starting from the low of the COVID, more or less. And value is almost there. Okay, so it's not really a value cycle, but value has done 19%. So we can say that we are back to kind of a more normal scenario. And then the classic is better than both. So we can say on the one hand, okay, value is not there, but at least the classic has beaten the growth for the last 5 years. And now I'm going to hand over to Alex. He's going to do a little bit more on these
Thanks a
index
lot,
funds and passive
Marcus.
asset management.
Sorry for the echo at the beginning of the presentation. Apparently there was an echo that was very, very bad. Hopefully it works much better now. Otherwise, let us know on the chat. I have just a couple of slides that I would like to share with you. You know, when you're actually talking to investors these days, most of the time to end investors, everybody towards the end of the year, it was absolutely clear that they have to own actually MSCI World, and maybe even on top the S&P 500. If you look at this concentration in MSCI World of the US, that went actually from 1988 from 32% to 71% in December 22, and actually went even higher at the end of last year, up to 74%. If you put that in relative perspective, you see actually that the US contribution to the global GDP is merely 25%. Now, of course, you can say, yeah, Apple and the likes are obviously global company and they impact the global economy, etc., etc. But still, is it threefold? We are not really sure. Maybe double, but three is quite a bit large. Now, Goldman Sachs actually at the beginning of this year came with a couple of interesting charts, and maybe you have seen them. If not, I would like to repeat them for you here. The left-hand chart basically shows the cumulative cross-border flows, fund flows into the US. It's massive. It's absolutely crazy. And it seems that there's just the US and the rest of the world is basically forgotten. The right-hand chart, the gray line is a one that you have seen several times, the top 10 of the S&P, concentration of them reaching an all-time high since the S&P. The blue line, the dark blue line, I like even more, because this actually goes back to 1925. When you look at the following, you look at the 10 largest stocks in the US equity market, and you count the market cap together, and you compare that with the 75th percentile stock. And then you watch or calculate how much time is the valuation higher. It was in the railway bubble 700 times, and we are pretty close to that. By far higher than in the year 2000. These are really signals for us. And of course, you could say, yes, these are the value guys hoping for a turn. But it's not only that. And I'm going to show you that in the next slide. I don't know how many of you have seen that Goldman Sachs came actually out at the beginning of this year with an S&P projection, 10 years returns, the baseline to be 3% per year. Usually you should make 6-7% from the index, but not 3. And David Kostin then indicated you should go equally weighted S&P and not market cap weight. To us, that's a very big signal to basically stock select. And in our view, that's the beginning of the renaissance of value investing. Now, if you look on the 10 years rolling window, as Marcus was already indicating, you actually see that, funny enough, in the Great Depression, or basically before that phase, in the phase of the railway bubble, there was a massive growth phase, as well as since 2011. There are clear indications on the next chart to the right that compares inflation and a rolling window of 3 years. If it's above 2.5%, then it seems to be a very good moment that basically value comes back. The last chart that I want to show you here is basically a similar version that Marcus already showed you, comparing here an index in brown, which is called international equities. And this index, international equities, is used heavily in the US for pension funds that have US managers, and in addition, they have foreign managers using MSCI international equities. Now, if you look at this index since summer 2020, you see the brown line here and the returns down here in the middle, 8.2% with a volatility of 12.9. If you look at the value component of that, which is the orange line, it already massively outperformed the MIC index and even more so, of course, the growth index, because you had 11.4 per year relative to 5 with a lower volatility, because remarkably, not only is growth performing bad, but also with higher volatility. And then I added here our classic fund with 14.3%, which is the blue line, with a standard deviation of 12.1. Now you could say, yeah, but your fund has also US names. Yes, it's true. We have 3 US names, but basically the weighting is ridiculously low. And therefore, I think it's absolutely comparable. And other funds would even say, why don't we call our fund an international equity fund? But, you know, we are not in this game, but I think it's an interesting point to add. With that, I would like to pass on back to Marcos.
Thanks, Alex. Okay, let's go to the 2 funds and the investment case in page 19. So this is the classic long-term investment fund classic. Last year we did 12%. In 2024, this is not surprising because in the beginning of the year we said that the IRR was 14% gross, 12% net of fees, and more or less, and that we show with, I think, in just 6% year to date, but it's only 3 months, so nothing special. Again, let me repeat that the portfolio is structured to comply with our investment philosophy. So we want to protect capital and a decent return, and thus our target is to make 10 to 12% per year net, as we have done since 2011 when we implemented the RAS risk-adjusted strategy. So last year, so this is the positive. The negative is that last year the MSCI World rose 25%. So how is that possible? I was asking myself, Europe was 6%, emerging market was up 4%, the Standard & Poor's equal weighted was 11%. Well, you know very well, it was again the Magnificent Seven. But you know, one message here, we want to double our invested capital every 6-7 years, which we have done for more or less 15, and we don't really care about NVIDIA. If it goes to P of 150 or it has bad results, we don't care. It doesn't affect us at all. And what is interesting is after this performance, which is quite good, Grifols, ISS, Reckitt, Energy as a theme, and Salmon as a theme, which are now more than half of the fund, all of them were negative in 2024. So we still think there's value, a lot of value in the fund. In slide 20, you can see the top 10 holdings. I'm not going to repeat that, the 4 Gs, good business, good managers, good balance sheet, good prices, and concentration and diversification. Again, you can see that we have a lot of different sectors in 10 names. The highlights, we keep very overweighted ISS and Grifols, and even Reckitt Bekinser. And we have a new entrant, Plaxi, that I'm going to recap a little bit later on. And then as sectors, we are heavyweight, our heavyweights are Salmon with 15% of the fund, oil and gas with 10%, and copper with 8%. So no massive changes, but a newcomer, Plaxi. In terms of IRR and intrinsic value, I was very surprised. We were very surprised when we did the update of all the models in the last 2-3 months with the results releases, because the IRR has jumped to 16% before fees. So the net IRR now would be around 14%. And this is well above our historical return and the historical range. So yeah, on this number, the IV is 1,300 or close to 30. Net, the fund looks really cheap, and we were wondering why. And maybe it's because we are a bit more concentrated than normal in Grifols, ISS, Plaxi, Reckitt, and then Energy and Salmon. But it's not a big deviation from historical, so it's not a big deviation from our normal diversification. So, you know, if we take our numbers, the classic is set to improve in the next few years from the 10-12, hopefully to close to this 14%. Obviously, we need to be right in our investment thesis in order to get this return. So, quoting Buffett again, we are hitting the ball real hard here. I'm going to put that into charts that you can follow nicely. This is the chart that I like to put is a 10% performance over time. And we started using this in 2021. And you can see that we have been very accurate with our estimates in the past 3 years because we didn't change the target. We've been very close to the target. If we do this 10% per year, which is our kind of target, 2025, we should be around 750 euros per share. And by 2028, around 1,000. And good news, the risk adjusters strategy is also bearing fruits in terms of beta, because the beta now is 8 versus, because managing the risk and rebalancing the portfolio is helping not only the performance, but also the beta, which is very important when we have a downturn. This is the bull case. I don't want to be over bullish, but this is what our numbers suggest. This is the 14% return that we would get if our numbers are correct. And you can see that already in 25, we would be close to 800, in 2028, close to 1,200, and we would double in 5 years. And looking at risk about what we are doing wrong here is probably concentration. So we are assuming a bit more risk than normal, mainly in Gurifolds, in ISS, and maybe in salmon, not really in oil. So, this is maybe the caveat of this. Page 24, you can see the look through of the fund. Easy to see that we are cheap, trading on 13.4 times 2025 and 1.9 times price to book. Look, we are under 2 times price to book, and the MSCI World is at 3.3 when our return on equity average is more than 15%. So we should be at least at this 3.3 level. Next part, Plaxi, which is a gift from Sodexo, page 26. This is a newcomer to the portfolio. It's formerly known as Sodexo Benefits and Rewards, and is the company that gives these meal vouchers, benefits and rewards like food or wellness, mobility, culture. And in 2024, this was a spun off from Sodexo. Why we do like it? Basically, good growth. We are convinced that these guys can grow above 5% per year, contract expansions with the existing client, new clients, and digitalization. The company itself guides to double digit in the next 2 years. We think there is some margin expansion to carry out, not massive, but we see margins at 37%, EBITDA margins at 37% in 26. And this is what we really like, the strong cash conversion. This company, if our investment thesis is correct, they can grow without investing, which is fantastic. It's one of the best business models you can have. So we can see a company growing 5 to 10% per year without investing significant amounts. And this is really what we like. Geographic diversification, 45% is Europe, 38% is Latin America. It is true that they have a big exposure to France and to Brazil, and they should make an effort in order to diversify a bit more, but it's a good diversification starting point. In the next slide, you can see the final things that we like. It's a disciplined management. It's a good management. They do bolt-on acquisitions, so no large transactions, and normally they are quite disciplined. Like the last time they bought Kobe in Spain, and we think it's a good acquisition. And in terms of digitalization, we think this is a tailwind. It's maybe difficult to understand, but when you get from physical paper tickets to something in the iPhone, that it's easy to go to the restaurants and to pay, to take the car and to pay here and there, it helps the business. So, Plaxi, we think it really matches with our 4G mantra: good business, good managers, good balance sheet, a good price. And if you look at the earnings, it's 11 times 27, well, 12.5 times 2026, and double-digit free cash flow yield. So we should make good money here. That is Plaxi, a new gift from Sodexo to us. Let's move to the Natural Resources Fund, page 29. The fund was up 8% in 24, a bit below what we expect, this 10% and 12%. But it was good versus the natural resources space because the index did -3 last year. So our 4 levels strategy is working and our quality assessment is working. And don't forget, this is the 5th year of positive performance. This year now we are flat because the fund is moving up, but it was not updated. But this is very much, related with the macro slowdown. I was commenting in the beginning, 23 and 24, the slower recovery of China, slower than expected at least, and then the arrival of the Trump administration with all the kind of uncertainty that is bringing. If you look at the space, most commodity prices are down to depressed levels, probably excluding uranium and copper, and the rest are very depressed levels. So there's a lot of money to be made if our thesis is correct. So we are not worried. And, if the fund goes down, we buy more, which is going to be better for all of us. In terms of investment, we are heavily exposed to oil and gas, 1/3, salmon, 17%, and copper, 20%. And we think the 3 are very well oriented for the next 2, 3, 4 years. So, we think that the outlook remains very, very good. Next slide 30, you can see the breakdown by sectors that I already commented, and you can see the top 10 holdings. Nothing really new to highlight here. Let me go through our philosophy, the 4 Gs, no need to repeat. Then scarce commodities, safe geographies, near production or in production, no startups, no majors, and the 4 subsectors that we use in order to play, when to high when the cycle is down and when to be more aggressive when the cycle is up, or also depending on valuations, of course. Next slide, 31st, you can see that the fund intrinsic value and IRR also jumped. The same thesis with the classic. So the IRR is now 16%. I often wonder why there is so much correlation of the IRR of both funds, but it is very easy. In the end, we're using mid-cycle valuation, which means that the valuation it has to be converging or very similar to the classic. So theoretical upside is 50% in the next 2 to 3 years, and the potential is much bigger. I often repeat that when the commodity cycles will be consolidated, it will carry much higher valuation because it's very difficult to bring supply and the demand is normally very inelastic. So we will see very high levels of commodities and very high returns, much more than the mid-cycle. We expect that to materialize in the next 2 to 3 years, so no change. And we give a guidance that we see the fund trading at 300 per share in the next 5 to 6 years. So let's see. In the next slide 32, you can see the look through. Here, there's not a lot of difference with the index because in the end, we are talking about natural resources. But if you look at the multiples, PE 11 times, 11.5, good dividend yield, price to book 1.2. So the fund is cheap. And now I'm going to hand over Carlos. He's going to talk a bit about the energy. Carlos?
Yeah. Yes, thank you, Marcos. Go to that slide. Well, this is two charts that I've shown several times because it is essential to understand that energy, it is not just one more sector or something that we use, etc. Energy is the only reason the intensive use of energy we do thanks to our machines, to the things that were discovered starting in the 18th century, is what has given us our standard of living. And you can see that in the extremely tight correlation that there is between energy use, you see that on the right-hand side, energy usage and standard of living, GDP per capita. The chart on the left, it is hard to believe, but it is true. Mankind did not develop economically at all since the beginning, since, 15,000 years, until 300-400 years ago. And the click is the use of coal, in that case, to use machines so that human beings can do, the same person can do 3 times more work, which means 3 times more output, which means 3 times more GDP than without the machine. Now, and that translates, as you can see in the next page, and I think we've shown that already in the past. This is not kind of abstract numbers. You actually live longer if you have more energy, as you can see in life expectancy. expectancy, and the standard of living. I mean, we take for granted that when it is cold in the winter, we just turn up the heating, and that's it, and we can live. And to us, the fact, and some of you listening to this, living in very northern latitudes, I mean, it's no problem for us. You know, it's -10 today. Okay, well, I won't play golf, but your life is normal. You can go to work, you can take your car, we can drive, you can take your holidays. If you really get fed up, you can take a plane and go to the Caribbean. I mean, to us, eating whatever we want to eat, whether it's meat, fish, vegetables, whatever, it is just a logistics issue. I mean, where do we buy the food? It is not an economic issue for any of us. Well, but that applies only to 1 billion out of the 8 billion in the world. If you go to the next slide, this standard of living in which we do not really think about material issues, as I said, is enjoyed by only roughly 1 billion people. The other 7 billion people in the world, to different degrees, of course, are far from there. For most of them, air conditioning is a dream, even if it's 42 degrees outside, or heating in there are very cold places in South America in the winter. Food is not that plentiful, it's not that good, etc., etc. It is amazing how little energy these people enjoy. And that is why exactly, directly, 100%, their standard of living is so much lower. Now, we tend to look at things, obviously, through our own eyes. And what we see around us is, abundance of energy. But it is shocking, that chart that I think I showed on the previous presentation, that there are more people living on the circle that you see on the left hand chart than in the rest of the world, which is pretty amazing because most of the circle is ocean, actually. And energy consumption there is much, much lower. You see a chart on the right, on the bottom, energy usage by countries, total energy. And you can see that Europe and Switzerland, even the US, have been going down, but the US stays at a much, much higher level. China has gone up. Now, it's very interesting because some people who are very keen on all those environmental things think that this is good that Europe is finally using less energy. But I mean, you have to add that line going down with a line going up in China. What we have done is basically export our manufacturing industries to China. So yes, we do use less energy, which now it is used in China, of course, with the concomitant transfer of wealth from Europe to China. And in fact, if you see the world line, which is the blue in the middle, yeah, it goes up gently, but not that fast. And then, of course, you see how extremely low consumption is in many areas. Now, Africa is just a name, like Switzerland, but it is almost 1 billion people. I mean, getting to 1 billion people. Indonesia is 200 million people, etc. So it's a lot of people. And the shocking thing, I mean, this is just kind of anecdotal, but it is true that our refrigerator, the fridge I have at home, uses more energy than most Africans use for everything they do in their whole year. So it is a very, very low level. And they also want a refrigerator, and they also want a car, or at least a motorbike to go places, etc. So if the conclusion from this is that the demand for energy, I mean, if those 7 billion people keep working as they are doing, of course, and they will, and we have in the past, if they keep working to attain our level of standard of living, the demand of energy is going to be enormous. Now, a very important thing, because we've been spoken to about the energy transition for years now, I mean, 5, 6, 7 years. The word transition means going from one thing to the other. Energy transition means dropping probably fossil fuels, and then using something else. Now, let's look at history, how this has worked. The little chart on top, the one on top on the right, is the different sources of energy throughout a long time. Now, what you see is that there are no transitions. I mean, people invent firing wood, the first thing mankind used to make fire and cook. So first use of energy. And because then you don't have to digest the things, so you can eat different things and digest them much faster and do many more things. But when coal was invented, firewood did not stop being used. Coal was added. Now, eventually, oil had been discovered many, many years before, but it became commercial beginning of the 20th century. And again, the addition of oil, which in many ways is a better fuel than coal, did not decrease the use of coal. It was added to the use of coal. Then natural gas. Natural gas is a wonderful thing, but of course it's much more difficult to handle than oil, because oil is a liquid, which is very easy, but the gases are more complicated to handle. But it has many other advantages, and in any way it is there, it comes with oil mostly. So, and in any case, natural gas now is usage of natural gas is almost as high as oil, but has not diminished the use of oil, etc., etc. Now, the narrative you see in the press sometimes with this obsession with the transition is that fossil fuels, and this is the chart at the bottom left, are going down as a share of final energy consumption. Well, this is obvious. If you have some fuels, some energy sources being used, and you add a new one, the previous one's share of the total goes down. It's a smaller percentage because now, the total percentage has to be 100%, and somebody is now taking up some of that percent. But the absolute amount being used, and this is what you have on your right-hand side, still goes up because the total market goes up. It's like the electric cars and the internal combustion engine cars. Say, no, now electric cars have 15% of the market. Well, but that doesn't mean that combustion engines are selling fewer cars. They're selling more cars because the market is growing. And as an investor, you don't make money by selling relative barrels of oil. You make money by selling real barrels of oil. And if you're selling more barrels of oil, you are making more money. Now, if somebody is using solar panels, well, good for them, but you are still making more money than before. That doesn't make any sense. So it is very important to realize, and this is the key message, that mankind is going to be using more fossil, not only not going down, mankind is going to increase the use of fossil fuels for a very, very, very long time, probably throughout our lifetimes. So there is no transition; it's an addition at best. Now, and in the next slide, actually, you can see, this is the previous chart that we had before: energy consumption by source, energy production by source, or consumption is the same, and now projected to 2050. Now, this line at the top, the black line going up, this is not just n'importe quoi, as they say in French. This is not just a line. I calculated what would the demand for energy be if the whole world were to reach the average consumption that we have today. The poor people, they don't get to our situation, but just to the average, just to the average. If they go to the average, the demand for energy would be the one signaled by the black arrow. Now, the question is, how is that going to be filled? Now, people who talk about transition seem to be implying that total energy will be served by alternative energies. Well, you can forget about that. That is the stupidest statistical thing that you can think of. What is going to happen is that every single source of energy is going to be increased, obviously at different rates for many reasons, but the demand for all sources of energy are going to increase. Now, the implications of this chart for investors are very, very important, because much of these are mostly investment intensive industries, so highly interesting to investors because that's where your money is needed. So it will be well rewarded, well remunerated. In the last 5 years, the West, Europe and US, has spent more than $1 trillion in alternative energy for a very small increase in production, whereas it has invested very, very, very little in traditional sources of energy, which are going to be needed. And since the basis is bigger, I mean, we still use much more oil than alternative energies. If you want to grow them at more or less the same rhythm, the investment in oil is not proportionally, but absolutely much, much bigger than for the others. And it has not been made. So we can think of enormous needs for investing. If you want to electrify more things, which is not a bad idea, you need a lot more investment in electricity grid, which is not being made in the networks, and a huge much more investment in copper, which is not being made. So you are going to have big sources of profitability there. We see the copper price finally breaking up because the market, well, now it's also because of the threat of tariffs. So this is to some extent a short-term move, probably. Americans are importing copper at high speed to anticipate, to get it in before the tariffs. But we know that there are no mines coming in 2026 of any import. So those prices, as Marco mentioned before, are going to explode, and they are starting to move. So we have mining, we have many basic resources, we have oil, gas, etc., where investment has not been made. So the world needs a lot more energy, and that energy is going to be delivered using all means available, and all means available are alternative energies, fossil energies, all kinds of things. And as investors, we have to look at where is the scarcity, and where is the bottleneck, and that's where we can get our best returns. Okay, that was my comment.
Thank you, Carlos. Yeah, very clear. It's amazing. We try to understand this year after year, and we still see coal consumption on a global level moving up every year, when coal is probably the obvious switch. Coal to gas is the obvious way to reduce emissions, but still emerging markets depend a lot on coal, and they're building coal power stations, and every year coal demand is up, which is still, surprising at this point. Okay, we're moving to another heavyweight in the sector, which is the salmon, in page 40. And we went to Norway again, to Bergen, for the salmon conference organized by the NASF. And I wanted to just give some feedback here, because it's a big position in both the classic and the natural resources. I think in the classic, from memory, is like 15%, in the natural resources, close to 17, 18%. So it's a heavyweight there. The biological situation is very good in Norway, so it's excellent. So we expect higher volumes at premium prices above spot prices. The sector is doing a massive technological effort, which I was even surprised, using closed and semi-closed technologies and systems in order to avoid escapes and avoid health issues. And they're even using lasers to kill lice, which I was surprised because I didn't know. So this means that the effort will lead to lower cost. On the short term, we do not expect high prices in salmon because the biomass is quite big, so there's substantial kilos to be sold. So our forecasts are more or less stable prices at around 7 euros per kilo at the source, with some margin for superior quality. Just remember that the current biomass, both in Norway and Chile, is now up double-digit, more or less. We expect also lower costs due to the good biology and also lower feed prices and efficiency plans. So, this means net that we should see better margins and better cash flow in 2025. Going to the next slide, there's consolidation in slide 41. So still the big guys want to grow and they will be buying the small companies. So we need to be aware of this consolidation. And in terms of supply growth, 2025 is estimated overall at 4%, well below the demand structural increase, which is 8% per year of flat prices. So the thesis remains very much intact: scarce supply or limited supply versus a hungry demand, put it this way. So this cannot be just can be balanced by higher prices. And then there's positive news maybe in September where we have general elections in Norway. And if the Conservatives win, then they said that they're going to reduce the resource tax that has affected a lot the sector in the past 2-3 years. So net positive outlook. If you look at the table on the right, you can see that the return on invested capital, this is our estimates, is around 14 to 15% on normal prices. We use 90 to 100 NOK per kilo. And look at the P's in 2026. So the sector is trading at an average below 9 times. So very, very interesting for us. Final slide on salmon in page 42. You can see the breakdown by countries in order to explain a little bit our thesis here. You see that Norway is basically 50% of the total supply for 2025. And Chile is another more or less 25%. So these two countries are 75% of the production. And the capacity growth there is very limited. So there is offshore projects, there is onshore farms projects, and all these is trying to build more capacity, but it's going to be very difficult to grow much more than 3-4% the supply. So nice sector to be in at these prices. So that's for the salmon farms, and I hand over to Urs on his thoughts on natural resources. Urs, please.
Thanks, Marcus. In the last call and also in the monthly or not monthly or newsletter, I explained the issue about the collapsing treatment charges in mining, which is the cost for the smelters. I'm not gonna repeat this, but it's visible since the middle of last year that we have a quite severe shortage in concentrate from mines due to underinvestment. And I've said that with the usual time lag, it inevitably results in declining output in refined metal. So this is now what's happening. On the left-hand side, we see the chart in copper, which is already going to or trading at new highs. And historically, all commodities are very correlated, particularly the metals, and this has its reason. A lot of metals come from the same mines. You always have various mines in mineralization. Here's an example on the right-hand side, byproduct from copper, which is cobalt, mainly a byproduct from the Congolese copper production. And you see this is already up 50% in the last few days or weeks, obviously from a very low level because it has been severely distorted by this whole hype in battery and so. But if you check out the prices of zinc, tin, lead, rhodium, alumina, and so on, we see the same development. And it's not unusual that the stock market is not that efficient. It takes quite a long time until people are realizing that this is obviously translating into better cash flows from these companies. I was always surprised sometimes that stocks went up only when the stocks share buybacks or dividend hikes were announced. Looking at prices, it's quite obvious in which direction it goes. So I think that looks pretty good. And with a bit of help from the economy, this will continue. The next slide, Alex. So I found a good chart from a technician in the internet. So I hadn't to do it myself. But these commodities are very correlated on the long run. And you see typically gold correlates to oil. It always reverses to a ratio of 20 times. And it's quite normal that gold is a leading indicator to developments we have because it's a monetary asset or demonetary asset. And then the industrial commodities have a time lag. At the moment, this spread between gold and oil is as high as it hardly ever is, apart from the COVID low, but we have a huge divergence now again. It's even a bit more extreme as gold is above 3,000, Brent at 70. And let's look at this time is different, but usually it always reverts to the mean. So that will give a fair value of the barrel of oil of rather 120 if you look at this ratio. Even the soft commodities are correlated to this. And if you look at historical moves, I'm doing this since more than 25 years. Surprisingly, it was always that the base metals were leading to oil. To be honest, I don't have an explanation to that, but that's what at the beginning 2000, 2002, and also on the top, oil was topping out much later in 2011 than the base metals. It was the same in 16, 17, and it looks like this is going to be the same again. And the next slide, Alex. The same issues. This is a chart from which we have shown quite often, you know, with the depletion. Without investments, we're going to have a massive decline in oil production. I don't know if you have seen that the OPEC skipped the International Energy Agency as a data provider because they are completely ridiculously useless. Carlos has often showed these projections of them historically. I mean, if you want to really make money, just do the opposite what they recommend. But even the International Energy Agency said now we need a lot of investments to counter this depletion. Chevron, for example, announced the first CapEx cut since the COVID low, and they are laying off 20% of the staff. I mean, this is pretty heavy, 20%. And then interesting is also, in my opinion, on the CapEx, we see a big shift from short cycle to long cycle, meaning going away from shale towards deep water, which is much more sustainable, but also has a much longer lead time because the US shale is maturing, and we will see the same what we have seen in the mining concentrate soon in energy, particularly in oil. The next slide, Alex. So this is just something I found from the sentiments towards general markets. People are extremely bearish. We have other signs again, CTA selling and so on at the extreme points. So I think in general that's probably a good sign for stock markets in general. And I mean, if you look at the things which are announced by policymakers, I wish everybody good luck who continues to save in nominal money instead of real assets. You need a lot of luck really in the future for that. Maybe the next slide, Alex. So the liquidity globally, I've spoken about that. That's M2. We have seen a decline towards the end of the year, which also was correlating with some last sell-off in metals, for example, but it's increasing. And on the next slide, Alex, is the global liquidity on a long-term basis. You see that the global liquidity was quite consolidating for the last 3-4 years, which also was correlated with consolidation in cyclical sectors, value, commodities, and we're breaking out to new highs at the moment. This is always not only the US or Western world, because you can look at China, what they're doing. Interest rate in China broke out on the downside. I think China has chosen the same path as the Western world when it started moving their interest rates towards zero. I would be a bit careful to be too negative on the real estate market in these countries, because I'm living in a country where interest rates went to zero or even below zero, which nobody of us could have ever believed in. And I've seen what it does to real estate prices and all these wealth effects. So maybe about a few words about the stimulus. So with the help of my friend Andreas Lambrou, who writes a very good stock market newsletter, Cambridge Club, he just did a little summary of the announcement, what is being discussed. So there's the Infrastructure Investment and Job Acts and the CHIPS and Science Act in the US, which should amount to $2 trillion. Japan has an economic stimulus program with new debt of nearly 200 billion euros. The European Union, Mr. Draghi recommended annual investments of 800 billion euros, what is 4 to 5% of the GDP of the European Union. China, since end of 24, has massive economic stimulus packages in the size of 1.3 trillion euros. And the government announced that they will issue special government debt in the size of 10 trillion renminbis, which is around, I think, 1.3 trillion euros. And then an additional issue of government debt of 400 billion euros to stimulate consumption and investments. And obviously, many people will have seen what some countries in Europe are doing. So they now do the same what they did 100 years ago, build road and motorways and then tanks to drive on them. The question is, who drives the tanks, where to, and maybe what do you want to protect, because the business in some countries is not needed any protection because it goes away voluntarily due to the obvious reason. But we have now stimulus programs in Germany, which goes up to 1 billion, half of it for infrastructure, the half of it for defense. Surprisingly, they included the climate also in the defense and security issue. So we will see, but that's obviously not going to be good for nominal savers in these countries. So I would rather recommend to invest what always has happening in these times, in real assets and in stocks rather than in nominal currency. Maybe an interesting issue is also, if somebody follows the discussion in the US, it's called Mar-a-Lago Accord. The problems about this debt is not really the level of debt, it's the debt serving, which is obviously something everybody has to pay. And we all know what all these governments, for example, in the US, cannot really afford this high level debt serving, which now with the time lag comes into effect. So we have to have lower debt serving. And there's the discussion to switch, for example, government holdings of government bonds, voluntarily or not, into 100-year zero treasury bonds. And you might ask, who is going to buy this? And we can assure you, this is going to be bought voluntarily by all the pension funds on the world. Because if you issue debt with obviously a huge discount, and the debt at the yield to maturity is 0.0001% better than the other one, everybody is going to buy it. So this may be something which is coming. This is the same reason why everybody bought the 100 years Austrian bonds with virtually zero interest rates. So that's nobody cares what the inflation is in 100 years. So, but this is going to be very, very inflationary and obviously very good for all the discussions we had. Then general emerging markets, commodities, value, infrastructure, and so on. Maybe the next slide, Alex. I think that's already the last slide. You know that we have positions in Russian companies, which is, I think, around 7% of the fund, which is valued at zero. On the right-hand chart, that's a fund which is an emerging market fund, which is quoted at the London Stock Exchange, which used to be the Russian fund of a big bank. And as it's quoted, it discounts obviously the expectations. On the left side, you see the biggest aluminium producer out of China, Rusal. The recent development is quoted in Hong Kong. And you see that this the stock market at least discounts some normalization in terms of this issue. And there's a lot of hidden reserves. Should this normalize, we would see a huge economic boom in Russia, probably similarly as a COVID effect, because there's a huge investment in the country coming. And I wouldn't be surprised that some American hedge funds, etc., will be able to buy Russian stocks. I would recommend the Russian Stock Exchange. Maybe the Europeans are not, but there's still some hidden reserves in our fund and many others as well. Alex?
Thanks a lot, Urs. With that, actually, I just summarize with two nice slides we can show. Basically, in the meantime, that's an actual slide of the classic of this week. Over 5 years, we are on a 98th percentile. and the natural resources, we are approaching basically the top decile. Now, with that, I would actually like to pass on the questions we have received. We have received several questions, and the first one was kind of expected. There was an update question on Grifols. Where do we stand there with the sentiment, etc.?
Yeah, well, I guess on Grifols, the fundamentals are doing really, really well, much better than expected. The stock price is super depressed and do not react or does not react. They had a capital market days in London where we were there with the CEO. We spoke to the CEO at length. And to sum up, the guidance they gave for the next 5 years is 7-8% growth, sales, organic next 5 years, better EBITDA margins in the next 5 years, some improvement to close to 30% EBITDA 2029. The net debt level now is 4.5 times EBITDA, and they will reach under 3 times. The business is doing well, so they don't see really that new products are going to harm their pipeline. They have a good pipeline, and all the proteins are doing relatively well. So, we were surprised by this, and we did a quick number. Let me give you a quick number. EBITDA 29, okay, it's 29, and there is business risk always, but let's take what the company says. The EBITDA 29 guidance is 2.9 billion. If you apply 16.3 times, which is the historical average of the company, I'm not inventing anything. 16 times EBITDA, you already get to 45, 46, 47 billion, take out the debt. But that time, I don't know, 8, 9 billion or 7 billion. You get to, I don't know, 40 billion roughly market cap, but the market cap now is 6, 7. Okay, so I don't want to enter in details. If Grifols continues to do as well, it's a matter of time that the stock will re-rate massively. We prefer to have a 20% per year and not a big spike in the name, but I don't see anything that threatens our investment thesis.
Thanks a lot, Marcos. There's another question. What do you think will happen to our funds when basically we'll have a slowdown or a recession, better said, in the US? What do you think will happen to those funds, Marcos?
Yes, well, we learned a lot in the past 2 cycles, and more we learn a lot in 20. The beta of the classic is now 0.8. If we get a recession in the US, it's going to be global. This means that the global market will be down 35% more or less, which is the usual correction. 35%, if our beta is 0.8, the classic would be down around 30%. This is our best hope. So we would do minus 30 versus the market doing 35 in a big recession. If you take the natural resources, the beta is higher, 1.2 times. So probably the natural resources would go down more than the market, maybe 40%. But then we would do exactly what we did in 2020, which is rebalancing the portfolios to higher IRRs and higher upside. And since the lows of 2020, we've multiplied, the classic has multiplied by 3 point something times, and the natural resources more or less the same, 3 point something times. So, a recession in the end, nobody can really, foresee it, or it's very difficult to really anticipate a recession because a crisis per se, per definition, cannot be expected. But if this happens, we are going to have prices down, but the values will still be there, and we'll make a ton of money in the following 3 years.
Marcos,
Maybe to add
question
also
for Urs.
to add something that stock markets in general don't correlate with GDP, but rather with the expectation of it, meaning it correlates with liquidity. So obviously, if you have a slowdown in economy, you have a growth in liquidity. So the stock market is rather correlating with that.
That's a question for you, Urs, which is basically, how do you see the situation in the US? Obviously, the Trump government tries to bring down energy prices. There's a slogan, drill, baby, drill. What are your thoughts on that, Urs?
I mean, this is completely ridiculous. I just wrote this in the newsletter. You know, if there's a country on the planet where the federal government has no influence in the oil production, it's the US. The US has 0.0 interest in the oil production. This is very different to other countries where the whole oil production is in possession of the government, or at least partly. So in the US, it's 0.0. And even the land in the US, because the US has a special situation regarding the mineral rights, they're attached to the land, which is very uncommon. Usually the mineral rights are separated from the land ownership. So the land is not, most of the land where commodities or oil is produced is not even in the hands of the US, and not even the mineral rights are in the hands of the government. And thirdly, you know, the whole regulation issues. I mean, if you look at the study in mining, which oil is also a sort of mining, you know, Nevada is completely different to California, and so they have a lot of you know, different, a lot of regulations are not at the federal government level. So in my opinion, this is just blah, blah. And obviously you see what's happening, you know, you look what the oil companies are doing and saying. I mean, they say, oh, this is a joke. We're doing completely the different things. So the real motto in the oil industry at the moment is cash, baby, cash. So they are reducing capex, they're laying off people, and nobody has any intention to drill more. This issue was the same with uranium some time ago, because US has a quarter of the world's nuclear plants and no uranium production. And there was always the discussion, it was in the last Trump administration. And, you know, nothing happens. The only thing you can do is really nationalize the production and say, okay, we start a national oil company and then start producing oil with costs above economic levels or something like that. That's what the Soviet Union did. And so, in my opinion, this is just political blah, blah, and there's absolutely no substance.
And maybe a question on copper. Have you seen it, Marcos? I think on the chat. By when do we think that large producers will start buying developers?
Well, yeah, in my opinion, this is happening already. Recently, we saw BHP bidding for Anglo American in seek of copper mines. We had several people talking to First Quantum after the Cobre Panama stop. Lundin Mining bought Jose Maria. Just these are few examples that the sector is not really willing to invest in greenfields because of the spot price is not enough. Although now it's $5 per pound, so starting to be a bit better. But yeah, the M&A is ongoing, and it's relatively an easy case to buy an existing producer rather than entering in a greenfield with all the risks of, you know, politics, taxes, ESG, etc. So yeah, this is ongoing, and it will accelerate. What you see in the stock market is very interesting. You see that the mid-sized producers, kind of Ivanhoe or Lundin Mining, these type of guys, Hudbay Minerals, they are kind of expensive versus the smaller guys like Atalaya. Atalaya has not this premium or M&A premium because they're too small. They are not really interesting for the big guys, but all the medium-sized guys are trading at very high multiples.
Marcos, thanks a lot. There's another question basically on the salmon side. How is it with the antibiotics? From time to time, there's always a slogan there or a headline in the media that the Norwegian salmons are really very bad, etc., etc. A couple of years ago already, there was a very interesting program in the Swiss television, and they asked basically an expert from the ETH in Zurich, a farmer, but a PhD in biopharmacy as well. How is the situation in the meat production in Switzerland? And at that time, because there was a lot of antibiotics, and at that time, this guy was really referring to the salmon industry. The salmon industry has done a massive step in the last couple of years to improve that. So this expert, really told and advised the farmer in Switzerland to look at the salmon farming industry, what they have done there, basically. It's true that a couple of years back, there were huge scandals, but I think this has improved dramatically. Maybe a question for Carlos. There was this question about Canada and the US tariffs. What are the implications on that, Marcos? Carlos?
Yeah, well, you know, with all these issues about tariffs, you can get very confused because that's probably the purpose of the exercise, to get us very confused. They're in, they're out. And estimating the impact of tariffs is impossible. Whatever you read, obviously, journalists and economists, and they have to tell you what's going to happen. But it is impossible. It's like introducing something weird in your body. Well, you don't know what's going to happen. But then you can think at a high level. Tariffs are taxes. I mean, you just, you know, you buy something, you put a tax. It's like VAT or like any other tax. Now, taxes in general, since they increase the cost to the buyer of the thing, they depress the demand for the thing. Now, demand elasticity is very different for very different things. And this is one of the issues we keep insisting when we discuss natural resources. If you are in the business of running, I don't know, trucks for logistics, to bring food to supermarkets. I mean, the price of oil, it's just a fact. I mean, you're not going to stop using your trucks because oil is more expensive, because then you don't have a business. Or if you make copper cable, well, you are going to use copper. You know, what can you do? So it is very marginal in terms of demand. The impact of tariffs is very marginal. You just increase, and then it has a funny side effect that you introduce different prices. Now, copper mined in the US becomes more profitable than copper mined outside, because the copper mined in the US does not have to pay the tariff. But all these things move. So, I mean, yeah, that is very nice to say. And then somebody could say, okay, then the people will start mining copper in the US. Okay, well, good luck to you, because it takes 15 years to develop a copper mine and get all the permits. And I don't think that Trump's tariffs are going to be there for 15 years. So the net impact is probably very, very small, as a matter of fact, because the reaction should be small, and in any case, it cannot be reacted. I mean, there is nothing you can do about these things. It will, like I said before, now you see copper in the US is more expensive already than copper outside of the US, anticipating the tariffs, but the difference is not enormous. And even if that difference, about 20%, were to stay, that does not mean that you can start developing copper mines in the US at high speed to take advantage, I mean, to arbitrage that difference in price, because it can't be done. I mean, natural gas prices in the US are 5 times lower than in Europe, but that doesn't mean that you can go take all the natural gas and bring it to Europe. You need a few gas tankers to do that, and a few liquefaction plants, et cetera, et cetera, et cetera. So I think all these tariff things create bad mood in the economy. It may impact the economy marginally, reducing rates of growth, but I don't think it's easy at all to estimate how this is going to impact the different industries, as a matter of fact.
Alex, maybe
That's my view.
maybe to add an example, because it was asked about, I think a question I didn't answer, is the oil industry. You know, the Canadian oil industry exports some of its oil 100% to the US. The refineries in the north of the US, they need Canadian heavy oil because they are designed. So if you put the tariff on Canadian oil, obviously it makes the gas at the station for the American consumer more expensive, but there's no way you can change that, because you would have to invest billions and billions in changing these huge refineries. And even if you have a lot of oil in the US, in the south, you know, that's also logistically not the same place as at the Canadian border. So, you know, the costs of 10, 15% would never be enough to justify the whole logistics, you know, to bring this oil. The US is not a small country. So at the end, this is absolutely zero effect. Only what's happening is that the price for the consumer at the end is 10% higher.
Exactly.
Thanks a lot. Looking at the time, we already are 75 minutes, but we still have 2 questions left that I would like to answer quickly. One is basically how is the defense position? If we have defense stocks, yes or no? We actually have bought 6-7 years ago Raytheon and Thales. In addition, MTU can be, of course, regarded as well as a defense stock. Now, the situation is 6-7 years ago, they were extremely cheap and inexpensive because ESG-wise, they were regarded as bad. We bought them not because we had the idea that the Cold War would come back to Europe, rather the opposite. But we bought them because they were absolutely top positioned in the information warfare, cybersecurity, and that's why we bought them. Now they have moved up extremely nicely already, so we reduced them, but we still have 5%. And the last question is maybe for Marcos, because it's the largest position in the fund, is on ISS. Maybe just a 1-minute update on that, and then we will conclude.
Yeah, sure. ISS is the second position. Actually, we are close to 10%, so close to the limit because the stock is up this year. They did also a guidance, long-term guidance with the results, and it was fantastic. So I'm going to give you one number. The free cash flow generated in 2025 expected is going to be around 3 billion Danish krona, and the market cap is 30 billion. So the free cash flow yield is going to be 10% this year, and then for the following years, because this can grow. So if you add to this 10% the growth, organic growth of the company, which is relatively easy to do, 4-5%, which has been in line with the history without acquisitions, you get an IRR of 15%. So things are going well. Guidance, yeah, mid-single digit. Margins already at 5%, which is the minimum they target. Balance sheet has been cleared. The stock is trading at 9 times earnings, 8 to 9 times earnings next 2 years. So, you know, this stock should be trading at 15. I don't know why it is now trading at this 15 times. Obviously, there is some short-term risk because the US is slowing down and Europe is slowing down. So there's some cyclical risks, but the name, we should make a good money here in the next 5 years.
Thanks a lot, Marcos. Thanks a lot, Carlos and Urs. Thanks a lot for you all staying so long. Like always, we are extremely happy and pleased. If you have additional questions, please get in contact with us. We are also happy to do a Zoom call individually if you like. Urs and me will be in the fund fair in Zurich in 2 weeks' time. And basically, we will have our Swiss Value Day and Natural Resources Day, and you will get the information pretty soon. Thanks a lot, and have a great day and a good rest of the week.